Hello, good morning. So today I'm going to talk about the S&P, of course, and what happened over the last 2 weeks. I will show you the topping process we saw in before major bear markets. So in 2007, 1987, and also 1929. After that, I will show you the charts of gold and also US bond yields, because there has been no flight to safety this week, which is a bit surprising. Regarding the S&P 500, so you can see here the regression line which has been forming since late 2016. So a strong uptrend. So you have the regression line on the middle and standard deviation, so plus and minus 2 standard deviation. So what we can see here in January is that there was an excess, so the market was trading more than 2 standard deviation above its rising regression line. And now we're starting to see an excess on the downside, at least in the short term, with the index falling 2 standard deviation below the rising regression line. So what we should expect based on this regression analysis in the near term is a low, probably in the short term around 25.50, possibly followed by a significant technical bounce. If we look at the topping process of 2007, so you can see here the topping process, we can see that the top took almost 1 year to be made, and we just started to see a bear market the next year. So it usually takes a long time to build the top, not just a few weeks, and during this topping process we very often have intermediate corrections. So you can see one here, and the market topped here. So before seeing a major trend reversal, usually it takes a long time, and it's not just after a 5 to 10% correction that we can say that the market has peaked. As you can see, in different cases we saw even a move back to new highs, which was the case in early 2007 and during the summer 2007. Now, if we look at the pattern just before the crash of 1987, you can see that same thing, the topping process took a few months. We had an initial decline in August of 1987, then a very significant technical bounce before the crash. And as you can see here, the index built a head and shoulder top before the crash. So right now, it seems that even if we assume that we are in the same pattern, I would expect at first a significant recovery, probably something to kill the shorts. If we now look at the 1929 top, as you can see here, very similar pattern to that of 1987. Initial decline, followed by a strong recovery, head and shoulder top pattern, then after that a strong decline and a market crash. Before switching to gold and US bonds, I would like to show you the relative performance of US versus world ex-US. So you can see here that the relative top of the USA was made just before the election of Trump, and since then the relative performance of the US has not been so good. This is mainly due to the weakness of the US dollar, and I think the risk in coming months is to make a relative breakdown US versus world, so to see a break below this support line, which would suggest possibly underperformance of the US stock market and or further weakness on the US dollar. Something very surprising, this is the relative performance of emerging markets. So we don't see any weakness except in the short term, of course, of emerging market versus world index. This relative chart even hit new highs at the start of the week. So this is something quite interesting, because we can see that even if the US start a bear market, I'm not convinced this will impact a lot emerging markets, and we can even imagine emerging markets outperforming in a US bear market. Now, if I show you very quickly gold, this was a bit disappointing week for gold, because usually when the market goes down, gold is going up, and this is not what is happening right now. We haven't seen any upside breakout on gold. You can see the strong resistance at 1355, 1360. So no breakout at this stage. This is a bit disappointing for gold, and suggests that investors still don't want to buy safe haven assets, even with US equities going down. Same story on US bonds. Usually when US equities are going down, you have a strong flight to safety towards US bond market. This is not the case right now. We are just in the formation of a trading range between 260 and 290, and no significant safe to quality move towards US bonds. I see that as a quite negative event for US bonds, which means that even if we start a bear market in US equities, investors are really reluctant to come back on the US bond market. Thank you very much, and have a nice week and a good weekend.